Okay, good afternoon, everyone. I'm very happy to open this session on inclusive green finance, a regulatory agenda, a session in which we will deal with the dual threats of both financial exclusion and climate change. And we will notice that these two are often interlinked. And our objective of today is to set up where we are standing right now with respect to inclusive green finance, and what can or should regulators do to foster inclusive green finance. Regulation should always have the objective to enhance inclusion, financial inclusion, as well as to fight against the climate change, and certainly without excessively burdening innovation in that respect. If regulation and policies are effective, negative impacts of the climate change can be mitigated for those concerned, and financial inclusion aspects that take care of leaving no one behind will help building resilience of the concerned communities, especially with respect to climate change. So our session is structured as follows today. I will be very happy to hand over the microphone to Walid Ali of the Central Bank of Egypt to give us an introductory speech on the topic. Before we have a first round of statements, and then we will have some rounds of questions also from you, obviously, and we're pretty much looking forward to that discussion. But before handing over to Walid, let me quickly introduce our very renowned panel of today. So Walid Ali is the General Manager of the Sustainability Department of the Central Bank of Egypt. He joined the CBE in 2006 and has 25 years of experience in the fields of management, setting strategies, capacity building and development, strategic planning, as well as sustainable finance and central banking. He also is a board member in the Center of Excellence for Research and Applied Studies on Climate Change and Sustainable Development, as well as a board member in the Egyptian Green Building National Council. So we are very happy, Walid, that you give us the honor to talk to us in Luxembourg here today. And we really look forward to your insights from a regulator's perspective. Right next to Walid, Caspar Wansleben is sitting. He is the Managing Director of Investing for Development, which is a Luxembourg-based impact investment fund manager, having the Luxembourg Microfinance and Development Fund, as well as the Forestry and Climate Change Fund in its portfolio. He is working in microfinance since 2006 and is also a visiting lecturer at the University of Luxembourg on social entrepreneurship. In 2022, Caspar was nominated as a member of the Luxembourg High Council for Sustainable Development. So from an investor's perspective, we're welcoming you here as well and look forward to your insights. Ilya Sverdlov will certainly be known to many of you already. He is a Director for Global Partnerships, Donor Relations, and the European Representative Office at the Alliance for Financial Inclusion, in short, AFI. AFI is a global network of financial policymakers and regulators in close to 90 developing and emerging countries. He oversees within AFI the engagement with strategic partners, government agencies, multilateral institutions, academia, and the private sector. And to the left, we have Professor Dr. Dirk Zetsche, who is a professor of financial law at the University of Luxembourg, where he holds the ADA chair in financial law and inclusive finance since March 2016. Dirk also co-leads the Faculty of Law, Economics and Finance's House of Sustainable Governments and Markets. If you have dealt with the topic before, you will certainly have read one of his more than 350 publications on the topic or listened to one of his talks within, be it universities, institutions of the European Union, development organizations and agencies, regulators, and so on and so forth. In November 2023, notably, he presented a roadmap towards inclusive green finance implementation at the COP27, so last year, together with AFI. And I think with these men sitting on the panel, we will have some very nice insights in the regulation of inclusive green finance. With that, I hand over to you, Walid, and I'm really looking forward to your presentation.
Thank you, Julia. Thank you for our esteemed panelists. Hello, everyone. It's a pleasure to be here with you today in Luxembourg, and thank you for the invitation to the university. Well, I'm here today to present in a very short period of time our journey as a regulator at Central Bank of Egypt about what we have done when it comes to sustainability/sustainable finance. Well, I wanted this presentation to be as much as actual, what happened on the ground, what really the challenges. It's not something that about achievements. It's about the real case that took place in Central Bank of Egypt and the Egyptian economy. Well, that's a nice picture of our building. Well, why we as a Central Bank of Egypt wanted to adopt a sustainable finance at the Central Bank of Egypt. Let me tell you quite honestly, if I went to the governor of Central Bank of Egypt 15 years ago and said, I want to talk about sustainable finance, he definitely will give you an appointment a couple of years later. We had no idea what it is. We were bankers by nature. It's all about return on equity, making profit, the financial stability and the banking stability. So we got lucky that it became very crucial, and we wanted to take it into action by initiating a sustainable finance department. So first we wanted to do the alignment with the international practices, right? We as a central bankers, we usually visit other central banks from all over the world, and the world was taking actions, and we didn't want to be left behind. We wanted to figure it out. We needed to know more. Also, we started to understand that there is a risk involvement, and we need to do risk mitigation. And the country on the government level, which usually live on another silo, they're taking a direction about this sustainability, and we need to jump within this boat as well with them to take it further, as we are the bankers who are financing all their projects. And then we discovered that there is an opportunity for growth. We wanted to kill the taboo of being green or being sustainable. That means less profit or takes quite some time to be successful. So that's why we want to kick in. Well, this is a summary about our journey. Excuse me, I have to turn now because I cannot see from the monitor here. Well, we wanted at the beginning to build our capacity as a central bank. They chose me to be the head of the department, maybe because I didn't have too much to do. But at that stage in 2013, we became a member of Alliance for Financial Inclusion. And we started the journey from there. And we started building our own capacity with the team of sustainability within the central bank. Then the Central Bank of Egypt issued a number of initiatives for the community. It was issued without putting in mind that it is sustainable. Like, for example, the modern irrigation initiative, where clients can be borrowed with a 5% subsidized by the Central Bank of Egypt, the natural gas initiative, the bakeries initiatives, which is a very famous initiative that we issued to transfer the bakeries that works with coal to natural gas. We didn't knew that these initiatives are sustainable and embedded within those initiatives, but we issued those initiatives, and then the official launch of the department, 2019. Then we wanted to come up with a framework that to be introduced to the banking sector in Egypt. We have 36 banks operating in Egypt, all types of banks, international, local banks, Islamic banks, national banks. And we want to put kind of a framework to introduce to them that their regulator eventually will go into the sustainable road. Most of the bankers, if not all of them, knows that when the regulators issue something non-binding or guidelines or principles, that means it's a matter of time that it will be transferred to a binding rule, right? So we wanted to introduce first a guiding principles that puts the framework and the direction of the Central Bank of Egypt. towards the sustainable finance, so the banks get the flavor and to start to build their capacity before putting this as a binding regulation. We will go with those guidelines in a moment. Then we had a huge sustainable finance capacity building. In the last 2 to 3 years, we trained around 40,000 plus bankers in Egypt about sustainable finance. Well, we didn't know what kind of regulations that we want to put together. I'm being very honest with you. So we had to do a gap analysis. We wanted to examine the bank's portfolios. Most of the banks doing sustainable finance lending without knowing that it is sustainable finance. They don't have the label for it. They don't know what categorization can be falling under. So they really don't know, most of them, because with 36 banks operating in the country, you will have all level of knowledge, advanced, middle, poor knowledge, no knowledge, everything. So after conducting this gap analysis, we understood that we're not quite far. We are there, but we need to highlight that and put kind of a framework so that the banks can work on. And we started with the first binding thing, which is we asked banks to get the flavor of the sustainability in their internal operation. We mandated all the banking sector in Egypt to measure their carbon footprint as a start. So now all of them, all the 36 banks having a carbon footprint measurement report, and they do it periodically as a start to practice that in their internal operation. Hopefully in their lending activities, they will do the same as well. Then right before COP27, which was held in Sharm el-Sheikh in Egypt last year, we issued our first binding regulations. I don't want to take time, much more time, but so let me go quickly. Those were the main guiding principles that we issued in 2021 as non-binding, and it was like a framework, as I said, to the banks to understand where the regulator is going. Of course, under each one of those guidelines, there's like a couple of pages with details, but we would love to share that with you and with the university so it can be spread. The first one, we thought that the building capacity is the first thing that we need to focus on. The enhancing of sustainable finance, involvement of stakeholders. In this particular point, we never used to deal with environmental experts as bankers, right? We never thought that on one day we will sit with someone who's talking about the emissions. And so banks needed to have new engagement, new agreements to get out of their own bubble to see what's going on in the world. So that's what it means, involvement of stakeholders. We started to work on managing climate change risk. And the fifth principle was applying the principle of sustainability within the bank's operation. As I said, measuring the carbon print, reducing the emissions in the buildings and their branches and so on. And the last guiding principle was the reporting. We started to tell banks that you need to report about your activities, your internal activities, as well as your lending activities. Well, the gap analysis was quite obvious. We wanted to measure the bank's portfolio. We want to examine everything. We needed to know where the bank stands. This gap analysis informed us about what's the next steps when we go for regulations, because we couldn't start without knowing what we have in the market, as I explained. We came up with a definition, like many other definitions of sustainability and sustainable finance worldwide. We came up that sustainability or sustainable finance in Egypt equals lack of data. So we came up with this, our own definition. So we started to create our own data. We wanted to have a base. We wanted to examine all the bank's portfolio, know all the details, not to read from a book and come up with theoretical definitions. No, we don't have the data, and let's get it. And that's what we did before issuing our binding regulation. Well, These are the main pillars of the binding regulations that we issued right before the COP. And I have to thank many of the colleagues who works in AFI, Professor Dirk and other colleagues from the World Bank, IFC. We learned from everyone. Okay, we came up with our tailor-made scenario. We looked into many countries' examples. We are a member of SBFN, of course, and the NGFS and others. We looked to other experiences, but you know what? We decided to tailor-made what is suitable for us, for the Egyptian economy and the Egyptian market, regardless if it is 100% compatible with the international standards. Of course, there are some boundaries that you cannot go behind, but still, we wanted to do something that has a real impact on the market, not to issue regulations or guidelines that banks can keep in their drawers and they said, you know what, it's one of the regulators' documents that we will talk about later. No, we want to see it happening. So we wanted to announce it right before the COP27. So the first mandate for the banks was establishing a department. And not only establish a department, and we mandated banks that this department must be reporting to the CEO or the deputy CEO. To emerging economy or a banking sector like Egypt, having the sustainability department, whom almost most of the market saw that CSR is sustainability, have this confusion. To have this department reports directly to the CEO of the bank, that was a huge shift. That's meaning a heavy weight for the department. Each bank should come up with the policies and procedures and vision about their activities in sustainable finance in the future. The third one is the board commitment. That means any single report from the bank to be presented to regulator must be approved by the board. That's a lot of work and it's a heavy responsibility added to the bank's boards. Reporting, we came up with 3 types of reports, which is annually and semi-annually, and the GRI report, which is quantitative and qualitative reports that examine the portfolio of the banks. And proudly say that maybe we are one of the very few banking sectors in the world whose any project will be financed by any bank for 200 million Egyptian pounds plus. The bank must hire environmental expert to write a risk report about the risk of the project itself. It's not 100% mandated now, but I mean, the action after the report of the expert, it's not mandated to take it further. I mean, you can still do the lending, even the report is not really positive. However, we wanted to embed in the bank's DNA that there is an environmental expert on the table with the credit committee, with the decision making to say, no, this project will harm the environment. So, and we are thinking of the upcoming regulations that the decision of the environmental expert should be obligatory as well. But this is something huge to decide because, you know, in many economies like in Egypt, well, we depend on lending or financing fossil fuel project and natural gas. So we don't want to stop lending, and we are not going to stop any lending, but at least we are trying to do the best and to mitigate the risks involved. Well, this is the slide that we brag about. 100% of the banks having now sustainability structure, sustainability policy, and sustainability reporting, and they measure their carbon footprint, including us as a Central Bank of Egypt. The beautiful building at the early slide. Well, we also did a CBE climate stress test. We didn't know where to start, actually. When I went to the macroprudential team and the banking supervision, telling them we need to do a macro stress test about climate, as they said, what's that? So, but we learned and we conducted that. The outcome, we used the NGFS scenario. we are fine out of the results that we got, but we wanted to have a longer term scenario, which involves from 5 to 7 years. So that's what we are trying to adapt over and above what NGFS has decided. So this is a quite comprehensive or just a quick story about our journey where we started. And during the session, maybe you can elaborate more. Thank you very much.
Walid, thank you very much. That was very... That was not only interesting from a regulating perspective, but also on how to put it in practice and how to achieve compliance. So thank you very much for sharing this national example of inclusive green finance and of achieving sustainability within the banking system. A wonderful start for our discussion, which before we start with asking questions, I would love to invite our panelists to give a short introductory remark because we have different perspectives here. So I would like to ask Casper to start first with his investors' perspective before Ilya comes with the AFI perspective, representing certainly 90 countries on the topic, before Dirk will close this introductory round with a financial stability perspective, arguing in favor of IGF. So Casper, the floor is yours. Thank you very much.
Thank you. And thank you very much for inviting me. Yeah, if we think about this topic, I see sort of 4 steps, which have a certain chronological order, but sort of also interlap. And the first step is we're coming from the impact investing sector, microfinance and green strategies. And so we believe in that we can, and this is step 1, where we all come from in this sector, is that we can define our own intentionality. And then we need to find credible ways to demonstrate what are we doing against this intentionality. And then we come together to build sector tools, to coordinate, to find a common language. And this is what we've seen in an impressive way this morning when we speak about the Universal Standards for Social Performance Measurement Standard number 7 on green and the Green Index and all this kind of coordination work, which has been ongoing. And that sort of falls into this realm that we can self-define what is good, what is green, what is positive, what brings us forward. I think then came sort of a second step where a lot of us perceived that what the people who are giving us money want starts in some cases to diverge. And what we felt there is that the green topic will become an overarching topic throughout. So even in strategies which are not explicitly have a green focus, there comes sort of a layer of, well, at least you need to demonstrate that you do not do harm, but you better need to demonstrate positive contribution to a green agenda, formulated in a wide way. That was sort of a second step, and that I think led also us to accelerate work on the first step, because suddenly we had to demonstrate that in a lot of different ways. We heard this morning, for example, from the EIB, how they look at it. They say 50% needs to be climate and green. So when you ask for money from the EIB, you need to demonstrate in some way how you're doing that, even if you're in a maybe coming from a social inclusion agenda. Okay, so suddenly these topics overlap. Then came the third step, and I think for me the third step was this European, very ambitious European regulatory agenda, which said that green, in a wide sense, climate change, biodiversity loss, etc., is now a very overarching priority from a regulatory standpoint. And it comes top down. It's a European regulatory framework. So suddenly I need to measure the greenhouse gas emission of the smallholder I finance in Zambia. I can argue whether that is useful and meaningful at the end of the day, but I need to do that. The regulation is asking me to do that. And is forcing an ESG layer consistently across everything I do with data reporting, data collection, data reporting, transparency, external verifications, etc. Very heavy process. And also in a context where suddenly everything is sustainable. Half of all investment funds, you have the impression, are sustainable now. And so this language becomes more important because it starts this ESG language and these standardized data reporting as mandated by the regulators become a sort of language of differentiation. I think we're still in the first phases of that, but it's emerging. And I think that is strongly coming. So I'm no longer in control of my own story like I was in step one, where I define my intentionality and I measure that in an industry way. Now suddenly I'm a sort of wider sector, and obviously the green seems to be much more prominent and much more forefront than the social dimensions, where we lack language, we lack taxonomy, we lack regulation, and that. So it's defining how the sector works, no? It increasingly works. And now we come to step number 4, and I think this was a very impressive example where we see this increasingly being replicated not only in a European context, but in the countries where we are working. I mean, you've seen this, that a lot of things are very recent. We saw December 22 wide-reaching regulation here in Egypt. We just looked at the Dominican Republic has made its own, has defined its own green taxonomy. So suddenly we see this kind of language, and I was told 20 centimeters, but obviously that's not true. So I'll come a bit closer. So where these things start to be replicated, obviously not in a uniform way, and obviously not on the same scale and ambition and nuances and details, but that means that that landscape becomes quite complex. It's not easy. We're lucky we have somebody like AFI and to try to coordinate and create standards, but it's becoming more complex because of course these kind of initiatives drive what my counterparties, my partners' priorities are and in which direction they want to do. So this is roughly how I see the 4 major steps where we are in, and where this really shapes much more what we're doing than 5, 6, 7, 8, 9, 10 years ago. And it's a profound change.
Well, thanks very much. I will do 10 centimeters, I think. Is that good? Can everybody hear? Great. Well, thank you very much, first of all, for the opportunity to tell you a little bit about how the AFI network as a whole is approaching inclusive green finance. But the presentation by our dear friend Walid really exemplifies to a large extent what the AFI network journey has been, starting from the very early stages with a few core champions who actually went to their governors and said, we would like to work on this. And the governors were kinder than how Walid has portrayed. And we have to ask ourselves first, why? Why are the central banks working on this topic? And particularly, why are the central banks in developing and emerging countries, given everything else that you have on your plate, are prioritizing this? And whenever we ask our members this, they tell us very simply, because for us, it's not theoretical. Yeah, it's in our face, it's today, it's urgent, and we're being impacted by it. And so inclusive green finance prioritization is very closely linked to your primary mandate, which is the financial stability mandate. Yeah, now we look at very typical November weather outside here in Luxembourg, and of course, all of us are experiencing climate change. Yeah. But when you talk to somebody from the small island states, when you talk to somebody from Egypt, when you talk to somebody from one of the Latin American countries, you get a very different perspective, yeah, particularly for the regulators. It's part of their work to ensure financial stability and to protect the most vulnerable. So AFI's approach to inclusive green finance focuses on the inclusive, and that is in everything that the central bank does. How do we make sure that those who are the most vulnerable are protected? Yeah, and we started, you mentioned 2013 when the Central Bank of Egypt joined AFI. This is about the time when we kind of started to think about this broadly. Yeah, and we had an initial cohort of a few champions who said we would like to do this, but at that time we really didn't know what, and what is the central bank's role. Then in 2017, together the members in an unprecedented way, 90 countries together across the global south said, inclusive green finance is something that we want to work on together. Yeah, and we will figure out how. Yeah, and this was the Sharm el-Sheikh Accord on Inclusive Green Finance, adopted at the 2017 AFI Global Policy Forum. But at that stage, we were still very, very early on. Yeah, so we started to ask one another, what are you doing? What is having an impact? Yeah, where are your knowledge gaps? And through that handful of initial members, we grew. The Inclusive Green Finance Working Group in AFI now comprises regulators and central banks from 60 countries who are working on these issues together. So in addition to the measures that Wally talked about from the Central Bank of Egypt, what are some of the other ways in which AFI members are approaching these topics? What are the actual very practical tools and policy levers that central banks can implement? The first one is central banks are increasing access to savings, especially formal savings, which buffer against cost increases, they diversify risks, they support recovery and reconstruction. Central banks expand access to affordable credit, particularly for vulnerable groups, but also for micro and small businesses, because this channels funds into low carbon technologies and into things like resilient housing and sustainable agriculture. Of course, inclusive insurance and agri-risk insurance schemes become very important, and here too an increasing number of central banks has a role in introducing them and supporting them and in making them accessible to vulnerable groups, and also strengthening national payment systems, yeah, because these too provide a buffer in times of shock, in times of crisis. Now, where do we see opportunity in the period ahead? AFI members see increasingly a tremendous opportunity in the area of digital financial services, and particularly new and emerging technologies, inclusive fintech, that have the ability to deliver insurance, savings, credit, and also to provide humanitarian assistance post-disaster in an efficient and effective way. So increasingly, digital policy and inclusive green finance policy are being linked. Members are asking themselves, how do we systematically ensure that inclusive green finance is part of national financial inclusion strategies? So increasingly they're working on this, and you see some examples there from the Central Bank of Egypt too. And finally, and this is a nascent area for us, but we think is incredibly important, and this is, we see that even among the vulnerable groups, some are even more vulnerable. And this particularly applies, you see, so now we have typical Luxembourg weather, yeah. So it particularly applies to women and girls, yeah. So as many of our members, I would say the vast majority of the AFI network is working extensively to advance gender-inclusive finance. How do you link gender-inclusive finance and inclusive green finance policies? We have a pilot project that we've kicked off recently last year, and we're looking into this area. Look, I will just say one more thing. Yeah, the very special nature of a central bank in the global south, yeah, which hopefully illustrates why their seat at the table is so important. In addition to playing a key role in sending positive signals on inclusive green finance to the market, because they're often the most stable, the most visionary, and the most apolitical public body in many of the countries in the developing and emerging economies, they play a critical role in pulling the whole ecosystem together, even if they're not the only ones that are advancing these efforts. Yeah, so the central bank often in our member jurisdictions can pull in the public sector, the private sector, civil society toward collective national efforts. And we see that as quite effective in a number of jurisdictions, including in Egypt. And one of the key elements of AFI's approach is really to ensure that these collective voices are heard, that our members have a seat at the table, and that their voices are part of the global inclusive green finance debate. Thanks.
Thank you very much. for the previous interventions, I look at much of inclusive green finance as a major regulatory experiment. Because at the outset is a state in which we all have to admit that we know nothing. It wasn't only Walid's Central Bank of Egypt that didn't know anything about it. Let's look at 2013, 2015. I would even make the claim that up to today, we know nothing. We have zero evidence, for instance, that the European Sustainable Finance Action Plan matters. We have zero data supporting that we do anything good other than for bureaucrats writing regulations. So, and if that is a starting point, then we should think a couple of times how we do make an impact, a positive impact. It's not about compliance with laws, it's about an impact. It's about doing something good for the planet. And I learned when I worked, for instance, with the Central Bank of Egypt, about one example that was so strikingly simple, but it's a high impact project. And that was a substitution of coal ovens in bakeries with gas ovens. It's a high impact project. It's not about being fancy and green, it's about impact. We save the planet much better, or we serve the planet much better if we erase these type of highly toxic small solutions, which are in some countries by the masses. I think it was 60,000, 70,000 bakeries, each of them with a terrible carbon footprint. And all of a sudden, they are not really crystal green, but they're not dark brown anymore. Yeah? So impact comes from the bottom upwards. It's not at 95 going to 100. It is from 0 going to 90. And this is exactly a mindset that is very, very well developed in many countries that work with simple solutions rather than with a highly sophisticated bureaucracy, somehow self-indulged with their own thinking and maybe overly theoretical approaches, as we can find in the European Sustainable Taxonomy. Everyone who's worked with these taxonomies and tried to apply it in, let's say, many countries of the world can just wonder who had the mental capacity to think of this in this way. Yeah? Because it's not focusing on impact, it's on a kind of very niche winners group that is labeled as super green and then gets more money. But maybe those who are already polluting should get funding to create a positive impact. Yeah, for me, as I said, we need bakeries in the world. There's no way that we get rid of bakeries if we want people to survive. So it's about how to make bakeries working with less impact. It's not about making them wearing a green coat every day. Yeah? So in this kind of thinking, how do we achieve impact? Impact investing, I think, is at the core of everything. And when we start doing that, then we think also twice about why we think about inclusive green finance. Inclusive green finance is a type of approach with which we create impact to the long-termism of societies. Because it is not so much about checking the boxes, it is really reducing the use of natural resources by ways that work today and not in 10 years from now. And for that, we need a certain simplicism in our approach. Everyone who believes in ESG investing today rather looks at impact rather than formal compliance. I think this is essentially something that we need. So I want to add one more component, and that is about why we should care from a more intellectual point of view. We face a problem, what Mark Carney has labeled the tragedy of time horizons. We need to invest today, but much of the benefits of our policy will be felt tomorrow, and that leads to underinvestment in the present. Yeah? So better than green is appear to be green and save the money. Okay? This is exactly the tragedy of time horizons we're facing. So what can we do about it? We can make a case for IGF, which justifies what we do today. And I think that case can be made quite effectively when we look at the impact of inclusive green finance approaches on financial stability. First of all, we have to understand in this regard that inclusive green finance has shown to be quite an effective crisis mitigation tool. When you consider what happened to the excluded in the time of COVID, where no one could contact them face to face, they were literally dying. And what we saw that in response to COVID, the number of hunger in the world moved up from 50 to beyond 500 million. We're not exactly sure whether we're at 1 billion back, but this was basically the numbers of the late 80s. So we have a significant step backward. And those society had a high level of digitalization, a high level of inclusiveness in the banking system, could respond by government to people payments. Those without bank access couldn't do that. Yeah, so crisis mitigation, I think today it's proven. 10 years ago, we had to discuss it, but the terrible incidents around COVID in many of the poorest countries of the world have shown that inclusiveness is life-saving. But the second aspect is that's also quite an effective crisis prevention tool. When these people don't have access to the financial system, monetary measures of central banks cannot work effectively. If they are not in the monetary system, then whatever you increase in terms of interest rate or cash injections in the system, whatever central banks can do, cannot work for the people that are not directly linked to the financial system. So a bank account is also a way of doing something for the economy, which is beyond the individual survival, but which is necessary to stabilize the whole society as such. But I think there's one third element which we should also keep in mind, and that is not underestimated. We need to know that whenever a crisis comes, we read in the newspapers about crisis, but very few of us have ever felt it, at least those who are in Luxembourg. The crisis for us is a bit of a theoretical thing. If you lose a job, there is a social state coming in and covering the cost for us until things get better. Crisis in other parts of the world means literally a struggle for survival. And in this regard, what we see here is that inclusive green finance can provide for better stability of these societies from the fact that when you have a larger number of bank accounts, you have usually a stronger internally developed capital market, and that stronger internally developed capital market can finance innovation and thus also function as a crisis cushion in the sense that there's a lesser dependency of that country on foreign currency, because a stronger internal financing replaces then a very strong dependency on the IMF or something else. Because what we felt in the past, whenever a crisis comes, the IMF first cut social programs. Social programs sounds like the first victim of every crisis. But when we can show that financial inclusion programs is de facto contributing to financial stability, we have a good reason to maintain them, because these are the programs that ensure that the central banks can still do what they do every day, which is maintaining monetary stability and also support of the respective economy. So I leave it at that. We could go on now, of course, for a bit more, but I think I'm done with my initial remark.
Thank you very much, Caspar, Ilya, and Dirk. That was already very informative, and I think I took out 3 things from this first introduction, which my main conclusion is basically that IGF is the opportunity to rethink regulation. Bottom up is certainly the better approach than top down. This is what I could hear from this side of the panel notably. Inclusion is a matter of broad oversight and not of little things, like we will not change the world if 2 of us start driving Teslas here, but it's something that needs a bit more reflection and something more than this. Yet smaller steps, as we heard from the Oven example, which I think is a really good picture, are certainly better than big, very illusionary steps, which are certainly the steps that we're currently trying to do with European regulation right here. And it's pretty much in reality to focus on things that are feasible, but that have an impact. So with that, I would like to open the first round of questions. So thank you very much again for these very, very good statements. Walid, regulation is always also a matter of cost on the side of the industry, of course, but also on the side of the regulation and overall for society, certainly. And if we engage costs, we also need to think about the benefits. So if you need to balance the costs and the benefits of regulation on inclusive green finance, do you think overall that the costs are justified by the outcome of trying to implement inclusive green finance?
Thank you, Julia, for the question. Well, indeed, it is there is a huge cost, especially when economies like emerging economies that starting from the beginning. Well, the cost itself for adopting inclusive green finance policies, that requires a lot of knowledge, and and getting the right employees to be trained and getting the capacity building. And that's cost a lot of money, identifying those expertise and bring them on board. The legal side of it, that's also costs. The financial institutions might need to invest in some technologies to come up with the requirements of the reporting itself. For example, if any risk management system that you need to adopt or to develop. So there is a lot of costs involved on the regulators, on the financial institution side. But on the other hand, the reward, even on the short term or on the long term, is definitely worth it, because let's be always very frank about this. It became very trendy that whenever you have any investment or any inspection from the World Bank, IMF, the big guys everywhere, the first top of the list now is green or inclusive or sustainable, right? Regardless of the definitions of the three statements, but it's on the top of the list. So we need to understand that if more investments are involved, more credit lines to be open to the banks, we need to take measures and we need to have policies in place to sustain those funds coming to the market. So it is definitely worth it, but maybe for the time being, it sounds to most of the banks, CEOs and heads that it is quite expensive. But on the longer term, we cannot really survive if we don't have this in place. Thank you.
Thank you, Walid. Caspar, talking about money, what must be the balance between the ESG return or the financial return for investors from the LMDF or the I4D perspective? How much from an investor perspective is IGF allowed to cost from the current point of view?
Yeah, that's the internal question. How much can it cost to go into this depth of measuring and collecting all the data on the impact side, which then is translated into action. I think, yeah, let me put it the other way around. The way it's conceived now doesn't work, because the way we define sustainability of financial products in the EU has to date not led, at least from my perspective, to any conclusive evidence of positive capital flows. So in this way, it's a cost without any corresponding element. Maybe not talking about concretely the return, but just the fundamental logic of the thing. So I think that, and it's very interesting that is a little bit the tenor of this panel, that I mean, what we're basically discussing here is there not a case to fundamentally rethink the approach, no? And become much more attuned to a bottom-up logic, a small step-by-step logic, and a logic where we are listening more. I recently sat on a panel with the ambassador of the African Union to the European Union, and he said, look, your Green Deal is not my priority. It's not what my immediate priority is. I'm much more concerned with inclusivity and economic growth. Yeah? And I think we need to listen to these things and attune our alignment according to what we're hearing there. So, sorry not to respond concretely whether it can cost a half a percentage point of return or whatever, but of course we have also investors who are increasingly concerned to see this kind of data and value to see it and realize that there's a cost attached to it.
Thank you, Caspar. Obviously, I was not waiting for numbers right now, and I didn't expect you to give us a numbered answer. So yeah, apparently we need to build a bridge somehow. What are the funding and partnership models for IGF that you envisage as AFI, and are there any specifics you want to mention on that respect?
Great, thanks. I was waiting for numbers, actually. I was hoping. But speaking of numbers, I'm going to say something which is kind of provocative for those of us who are aware of the kind of green financing debate. Not enough financing. I would argue that there's actually plenty of financing, and in fact, more funds chasing good projects than good projects chasing funds. How do you marry the two? Yeah, so for AFI, It has to be, when we talk about funding partners, I don't know if any of our funding partners are in the room. I don't see, which means I can speak freely, but I would otherwise. No. We look for like-mindedness. Yeah. And what does like-mindedness mean for an organization like AFI? Well, it means exactly that we look for partners who support our members in the way that our members want and need to be supported. Yeah, where the priorities are aligned. But, you know, Kaspar, you talked about the ambassador from the African Union saying, for us, these are the priorities. And this is important in Europe, but it's secondary to us. So key criteria for AFI is finding those like-minded funding partners that listen to our members, to central banks, and say, yes, we recognize that what you're doing, and we'd like to support you in the way that you would like to do it. That's number one. Number two, we're very fortunate to have a high degree of technical expertise among our funding partners. So the funding is important, but it's not the only thing. It's really what else does an organization bring to the table, because inclusive green finance is so complex. We need all of our collective expertise to tackle these very challenging issues. Now, you asked about other partnerships too, so I will mention, we talked about the IMF, World Bank, IFC. When AFI supports its members in developing and implementing inclusive green finance policies, we work on the regulatory side, but often that creates demand for an opportunity for much larger investments into infrastructure and to other things. And this is where a whole spectrum of partners come in and help AFI to scale the work that we do. I see our colleagues from the GIZ here. So this is one of the ways that we work with EBRD. You mentioned EIB, IMF, and others. Another set of partnerships is with the private sector. You cannot tackle these issues without systematic engagement from the private sector side. So what AFI does, we've established a public-private dialogue platform that looks specifically at what the two sides, the regulators and the private sector, can do together to overcome market and regulatory barriers and take advantage of opportunities that are out there. I think, Walid, you mentioned NGFS, Network for Greening the Financial System. So this is a network of developed country central banks who look at a broader spectrum of issues. But this is where our members come in and present the inclusive green finance point of view in these networks. Academic partnerships cannot be ignored. And of course, key among them is our partnership with the University of Luxembourg, ADA Chair, and the development or the co-development of the IGF Roadmap, which was launched last year. And finally, it's all of you out there in the audience. Yeah, Luxembourg has created such a dynamic and vibrant sustainable finance ecosystem of which all of us are part. Yeah, so these partnerships for us are also key in order to advance these issues together and to learn from one another and to benefit from one another's insights.
Thanks a lot, Ilya. Minding time, I would love to ask one last question to Dirk, and I would love to also take one question from the audience before we close. So Dirk, it's a yes or no question, Dirk. So all in all, would you judge that emerging markets and developing economies are successful in their IGF approaches? Yes or no? And one sentence, why? Thank you.
It depends. The answer is some of them share the mission, not the methods, and find extremely innovative approaches to the same issues that we're facing in Europe. Second sentence, we need smart projects, not dumb small projects. Smart projects like that one, I can give you an example from Nigeria. They have the idea of reducing the dependency on oil and gas by giving tailored products for alternative type of industries. And the idea is to bring the dependency of oil and gas down from 40 to 30% in a decade. That is probably more green than what we have achieved with every type of taxonomy. I hope this was short enough.
This was very short. Thank you very much. So if there is a question from the audience, there is one here on the right-hand side. I would love to take that one. And then since we started 7 minutes late, I think we're allowed to take some more 3 to 4 minutes. Over there. Yeah, thank you.
Thank you very much. My name is Klaus Prohaska. I'm heading financial sector development at GIZ. Great discussion. My question is for Mr. Walid Ali. And it's a conceptual one. What is your view on the relationship between sustainable finance and financial inclusion? And I'm asking that because you seemed to discuss a lot on mitigation, on measuring carbon footprints, being in the NGFS. So to me, that sounded like a mitigation initiative. But when I hear to the other colleagues on the panel, that was all about savings, credits, digital money to bolster resilience. So that to me seems more like a social idea. I think the Central Bank of Europe Egypt also has a financial inclusion department. How do you deal with this relationship when sustainable finance in the end should also be environmental and social? How do you deal with that as an institution? Thank you.
Thank you very much for the question. Well, not to say much, but or to say that we have a supervision, but we had a vision early from the beginning, when we started to establish our department, that we need to have the sustainability department, the department that I'm heading, and the financial inclusion department under the same umbrella, under the same reporting line. And most probably, we are the only central bank is doing this, because the international standards, according to IMF or the World Bank, or even SBFN, that sustainability could be reporting to the deputy governor directly or the governor. But we that's puts us again to our concept in Central Bank of Egypt, that we do whatever we believe that tailor-made suits our market. We had the vision that financial inclusion and sustainability in general goes hand by hand. So we had them together under the same umbrella, the same reporting line, and we work very closely together on the day to day. So, however, there are by nature some differences between the operation, between what the team for financial inclusion is doing and the sustainable finance. But whatever practices that we are adopting in the sustainability department, we do the same with financial inclusion. Over and above, we have our colleague here in the room, who's the head of microfinance at the Central Bank of Egypt, and he is under the same reporting line. So all the elements that contributes in achieving the SDGs at large, or sustainability at large, under the same umbrella when it comes to operation, to make sure that we are aligned. We had enough of living in silos. The government living in a silo, the banking sector in a different island, everybody doing their own perfect effort, but it's not unified. So we decided to do it differently at Central Bank of Egypt, to have everybody on the same floor and see how all the ideas can achieve the same goal. I hope that answers your question. Thank you.
Thank you very much. So to close this panel, I'm afraid let's take one last question and we might skip the conclusion statements. Yeah, you're right. I was thinking about that as well.
Natalia Realpe from Edera Sustainable Solutions. I was surprised by Professor Dirk about, you started showing the case of impact from microfinance institution with a product, and we have struggled seeing microfinance institutions doing pilots, as I agree, are very impactful. But at the same time, you said regulations, it's not only about setting up the bureaucratic steps as CBE is showing. No, we have to comply, at least having a department, having reporting system, approving reports and so on. So I thought that, and reading also your work, I thought that your proposal will be rather in regulatory agenda. How can we help central banks to develop sandbox, like the fifth, I will say, like before, we have this 4 P's of action for central banks, and I will add a 5th one on practice. And my question to you is how, or what will be the steps for regulators to take or to guide them in developing products? One thing is setting up the strategy, that is the beginning of what CBE is showing, that they will reach that. How to do this product development without failing in the, or failing in the process, but fomenting establishment.
Thank you for the question. First of all, we need to adopt what we call a sandbox approach. That means admitting that we know very little. We need to try, test and learn. Mutual learning is very important, which takes place among the central banks of the AFI network, for instance. So they sit together. You have to be in one of these places to understand what this means. You sit together and there stands up someone who is responsible of a budget and say, I failed with that approach. So why did I fail? Well, we analyzed it. And then someone else said, well, we had the same experience, but we did it slightly bit different, and that worked well. So, and this type of mutual learning is extremely important to find the right way. The second thing is national priority. You need a national solution for national problems. So where your problem is bakeries driven by coal, then tackle that one. But for that, you need to know your sector. Uniform approaches, global approaches don't work because the problems are national. Some have too much water and the other side has too little water. That's just important to understand. There is not a uniform solution to the global problem of sustainability. There is just a national solution to your problem on the doorsteps. Third element that concerns the level of rigidity of regulation. I'm a friend of regulation, but I'm not a friend of rigidity. That means you can regulate by drafting broad principles and find common sense on the ground, or you can write nitty-gritty rules. Very important. I share the mission of the European Sustainable Finance Action Plan, but I don't share the method. That's a very, very big difference. I can achieve the same with principles and draft broader rules which are filled with common sense rather than with black letter ink. I think that's my short response.
Thank you very much. So minding time, I would like to close the panel. I think the overall conclusion we can take from here is that there is still a lot to do, that we need to think not top down, but bottom up, that we need to rethink regulation and in any case, step back from over-regulating these topics to make it more realistic. Thank you very much, Walid, Kaspar, Ilya, and Dirk for having this discussion. Thank you for coming, and thank you to the audience for your close attention and interest.